I'm Karen Sanchez, Senior Investment Analyst for the Multnomah Group, and this is our market commentary for the fourth quarter 2023. Inflation has been easing. Core CPI, which excludes food and energy prices, rose at an annualized rate of 3.9% through December. This is down 20 basis points from September's numbers and down 180 points from December 2022. The Fed's preferred measure, the Personal Consumption Expenditure Index, slowed to 2.6% over the 12 months ended in November. With an eye on softer inflation numbers, the Fed Reserve again held rates steady at their December meeting. And while much of the market feared a recession, Treasury Secretary Janet Yellen stated on January 5th of this year that the Fed had achieved a soft landing. The U.S. economy rose at an annualized rate of 4.9% in the third quarter, up from 2.1% in the second quarter. The increase was broad-based, reflecting higher spending by consumers and investments in private inventory, as well as municipal and federal government spending and non-residential and residential fixed investments. Imports and exports also increased. Employment numbers came in strong in the fourth quarter. Non-farm payrolls were up 216,000 in December 2023. The unemployment rate stood at 3.7%. That is a slight increase from December 2022, when the rate stood at 3.5%. The consumer feels positive about their personal financial circumstances and the economy in general. The January surveys of consumers from the University of Michigan show that consumer confidence is building. Their index came in at 78.8 points. That's up 21.4% from 1 year prior. However, this is still below pre-pandemic levels. After a disastrous 2022, which saw the Bloomberg U.S. Aggregate Bond Index down 13%, the benchmark was positive for 2023, up 5.5%. All sectors had positive returns, with high yield returning the most, up 13.4%. For the fourth quarter, the benchmark returned 6.8%, led by long government credit up 13.2%, developed international bonds up 10%, and emerging markets debt up 9.3%. Two-year Treasury yields stood at 4.2% for the close of the quarter. 10-year yields were at 3.9%, and the 30-year Treasury yields were at 4%. The yield curve remains modestly inverted. While yields to the belly and the end of the curve were relatively unchanged from 1 year ago, yields varied widely during the fourth quarter on speculation regarding Fed rate moves. October's high were 5.07 on the 2-year, 4.88 on the 10-year, and 5.04 on the 30-year Treasuries. The S&P 500 returned 26.3% for 2023, led by gains in tech stocks up 57.8% and communication services stocks up 55.8%. On a market cap and style basis, large cap growth stocks saw the largest returns, up 42.7%. Two sectors had negative returns in the year, as energy was down 1.3% and utilities down 7.1%. For the quarter, the S&P 500 was up 11.7%, led by gains in the real estate and technology sectors. As we've mentioned in previous commentaries this year, broad market returns were concentrated among a handful of companies. The so-called Magnificent Seven stocks, Apple, Alphabet, Amazon, Meta, Microsoft, NVIDIA, and Tesla, represent 26% of the market-weighted S&P 500 benchmark. Their returns vastly outpaced the index in 2023. NVIDIA was up a startling 239%, while Apple was up just 49%. The narrow set of outperformers in the index is a consideration as we monitor active managers. Concentrated funds that invest in a select group of stocks run performance risks if their holdings don't include the market leaders. On the other side, diversified fund managers are regulated in how much they can hold of any one stock, and the total weight of the Magnificent Seven could push them out of capturing their full return potential. U.S. equity outperformed both international developed and emerging markets. The Russell 3000 Index, a domestic all-cap benchmark, was up 12.1 for the quarter and 26% for the year. International developed markets, represented here by the green bar, were up 10.6% for the quarter and 18.6% for the year. Emerging markets came up behind, returning 7.9% for the quarter and 10.3% on the year. All regions of the world saw gains, continuing to benefit from a post-pandemic reopening. Emerging countries in Latin America performed the strongest, up 33.5% for the year, while emerging markets in Asia lagged the benchmark, returning 8.2%. All eyes remain on the Federal Reserve and their next meeting at the end of January. While Fed comments indicate that 3 modest cuts to the Fed rate are likely in 2024, starting in mid-year, market consensus appears to favor more rate cuts sooner and deeper. Markets typically keep a close eye on regime change, and 2024 is a presidential election year. And while President Biden signed a continuing resolution to fund the government in January, this is a stopgap. It funds the government only until March. Congress must come to an agreement on budget, which for 2023 was projected at $6.1 trillion. Globally, markets are concerned that Israel's war with Hamas may spread to a regional conflict, imperiling energy supplies. The war in Ukraine also threatens commodity supplies. Another concern is global shipping logistics, as militants in Yemen are targeting shipments through the Red Sea, a major shipping route. With inflation slowing and signals pointing to a soft landing for the economy following the Fed's aggressive rate hikes, consumer sentiment about the economy is rising.